Thank you for joining our webinar today. It's good to see you all. My name is Peter Webb and I'm a tax advisor with the Fry Group. So today we're going to be learning about leaving the UK to live overseas and the tax essentials you need to know. Please do not take any action on the basis of this webinar alone without seeking specific advice for your personal circumstances. And please do ask questions as we go through the webinar. You can do that by using the Q&A button. And we're going to try and answer as many of your questions as we can at the end of the presentation. I'm going to be joined by a great colleague, Chris Davies, for our Q&A session. So on this slide, you'll see our agenda for today. Please bear in mind, again, don't take any action on the basis of this presentation. Seek some specific advice for your plans. And I would also mention that we're only going to be talking about UK tax. So please do have regard to any other tax implications there may be anywhere else for you. So the final point on this agenda is your questions. So actually, I do have a question for you. And that question is going to pop up on your screen in just a little minute. And that question is, when are you going to move overseas? You have a few answers to pick from: within 12 months, within 2 years, 3 years plus. And I'll give you a little bit of time just to pop your answers in. I can see lots of votes going in. Okay, I think that's stabilized. So I think everybody's voted. So we'll then share the results if we can. Okay, so it looks like 41% of the people who are attending the webinar are going to be moving overseas within the next 12 months. Oh, that's an amazingly high number from where we usually do these polls. And a quarter of you, it's going to be 3 years plus. So plenty of planning time. Okay, thank you. So what do you need to consider when you start planning this move overseas? There are an awful lot of ducks you need to get into a very neat row before your move overseas. Pick up on a few of these. When will you make your move overseas? What is the best timing for you? Will your family be moving overseas at the same time as you, or will they be moving before you, or will they be come to join you a little bit later on? This can have really quite a profound effect on the tax position. The timing of when accommodation becomes available overseas can have a huge bearing on the date you may become what we call non-UK tax resident. Oh, cost of living. Will your costs of living be different overseas than they are in the UK? This is very, very likely and needs to be understood. Excuse me, just an example here in Singapore, where I'm based, on the 1st of June, my rental is going to go up by 40%. It's these kinds of costs that you need to know about before you move. And are you leaving the UK to work overseas and then return? Or are you retiring overseas? You're going to have a very different UK tax plan if you know you're going to live in the UK again than if you're leaving or have left the UK permanently. And bearing all of that in mind, an important consideration is how much UK tax will you continue to pay as an expat? And really importantly, is there anything you can do to reduce your UK tax bill? Bit of a sneak preview there. So why do you care about becoming a non-UK tax resident? Well, your tax resident status determines how much tax you pay in the UK. So when you're UK tax resident and you're what we call a UK domicile as well, and then you've seen the sneak preview on that, we're going to dig into that a little bit. You're simply fully taxable in the UK on your worldwide income and worldwide capital gains as they arise. UK resident, UK domiciled, you're taxed on everything, everywhere. However, if you can become non-UK tax resident, and generally you're going to be non-UK tax resident for more than 5 years, then you're only charged to UK tax on UK sources of income, and the liability to capital gains tax, which is why you need to be outside of the UK for more than 5 years, is then just limited to the disposal of UK land and property. I guess to be complete, assets used in a trade can be caught as well. As long-term non-UK tax residents, any overseas income and any other gains, apart from the disposal of UK land and property and assets used in a UK trade, they're not charged to UK tax. Now, if you're going to be non-UK tax resident for less than 5 years, if that's your plan, then you're going to need to take a little bit of advice, as there's some really tricky rules to be aware of. And we're going to come back to those a little bit later on. But to give you a bit of a headline there, they're called the temporary non-residence rules. Your UK tax resident status is incredibly important. And if you can achieve it, a precious non-UK tax resident status is going to significantly reduce your exposure to UK income tax. If you're out for more than 5 years, UK capital gains tax as well. Okay, so this is one we had a bit of a spoiler alert on, why your domicile status matters. So, as well as a UK tax resident status, you have another tax status that is equally as important. Your resident status is assessed each year under the statutory residence test. We're going to explore that in a little bit. But your domicile status, rather than being determined each year, it is generally determined over your lifetime. And everybody does have a domicile status at every point in their lives. Generally, you acquire a domicile status from your father's domicile status when you're born, and we call this your domicile of origin. It's very hard to shake off. Now, that's a simplification. Matters can be far more complicated than that. So if you're UK domiciled, your worldwide estate, all of your assets everywhere are within the charge of UK inheritance tax. That inheritance tax liability could be as high as 40% on everything you leave above £325,000. But if we can say you're not UK domiciled, then your exposure to UK inheritance tax is limited to only UK assets. Your overseas assets, your non-UK assets, are not within that 40% UK inheritance tax charge. That's incredibly advantageous for you. I just mentioned very briefly, in addition, when you're UK resident, a UK domicile, you're taxed on all income and gains arising anywhere in the world. But if you're a UK resident and you're not UK domiciled, you can exclude what we call your unremitted non-UK income and your unremitted non-UK gains from UK taxation. A quick aside to this, actually, I think the most common question I'm asked is, I've been non-UK tax resident for more than 20 years. I don't really plan on returning to the UK. Although I had a domicile of origin in the UK, does that mean I'm now non-UK domiciled and I can escape UK inheritance tax? We'll come back to this a little bit, but I think it's very, very hard to displace your UK domicile of origin, if that's you. And just being overseas for a long time is not enough. So we've been exploring a little bit the differences between being UK tax resident and non-UK tax resident. So now what we're going to do is focus a little bit on that really tricky transition between those two tax resident statuses. So how do you know if you're a non-UK tax resident? Since 2013, we now have what we call the statutory residence test. And that's the legislation which is used to decide whether or not you are UK resident or not UK resident. The statutory residence test, it's a 3-part test. And each tax year, what you do is you work through those 3 parts of the tests in order, step 1, step 2, step 3, until your resident status is decided, and then you stop there. The first of these 3 tests is, are you automatically overseas? Are you automatically non-UK tax resident? The second test is, are you automatically UK tax resident? Are you automatically in the UK? Now, if your UK tax resident status isn't determined by step 1 overseas or step 2 UK, then you fall into the third and final part of the statutory residence test. And we call this the sufficient ties test. Now, under that sufficient ties test, you consider the number of connections you have with the UK. We call these ties. The more ties you have, the less time you can spend in the UK and be non-UK tax resident. The fewer ties you have, the more time you can spend in the UK and still maintain that non-UK tax resident status. Now, we really like the statutory residence test because it gives you certainty. It sets out the limits, you stay within those limits, and you can achieve that non-UK tax resident status. What we don't like about the statutory residence test, it is very complex. There's a lot of detail here, and there are traps for the unwary and ill-advised, and some of those traps are big enough for an elephant to fall into. So we're talking about that tricky transition from being a UK tax resident to becoming a non-UK tax resident. So how does this work? Under the statutory residence test, we've just discussed you're either tax resident for the year or you're non-tax resident for the year. Now the tax year runs from 6th of April to the following 5th of April. So if you're UK tax resident for this tax year, the default position is that you're UK tax resident for the whole of the year. Now remember, when you're UK resident and UK domiciled, you pay tax on your worldwide income and gains as they arise. So if you move overseas partway through this tax year, what's to stop, for example, your overseas salary from the date you leave being taxed in the UK until 5th of April 2024? Well, there is some help for this, and we call it split year treatment. What split year treatment allows you to do, it allows you to not default to being UK tax resident for the whole of the year until the end of the year in which you leave the UK. And it allows you to achieve a non-tax resident status before the end of the tax year. And that will reduce your exposure to UK tax because you've become non-resident at an earlier date. And once you're non-UK tax resident, particularly in that first year for income, as soon as you're non-UK tax resident, your liability to UK income tax is then limited to UK sources of income only. So when you leave the UK, there are 3 different ways you can become non-UK tax resident partway through the tax year. Just very briefly, perhaps there's a date when you start full-time work abroad, or perhaps you're accompanying a spouse who is starting full-time work abroad. Or the third way you become non-UK tax resident partway through a tax year, and this might be more relevant if you're retiring overseas, is perhaps there's a date when you cease to have a home in the UK during the tax year. There are very specific requirements and conditions that you need to meet to achieve the split year treatment. It's a lot of detail, and you're going to need to seek professional advice to ensure you're going to qualify for this really beneficial tax treatment. So you've managed to get overseas, you've managed to achieve that non-UK tax resident status, perhaps under those split year treatment provisions. We mentioned previously that there are some really special rules if you'll be UK non-resident for 5 years or less. And we call these the temporary non-residence rules. When you return to the UK after a period of what we call temporary non-residence, you may be charged to UK tax on certain income and gains you received or perhaps even remitted to the UK in that period of temporary non-residence. And the charge to tax arises in the year that you return to the UK and you trigger UK tax residence once more. So when do these rules apply? Well, broadly, if you were UK tax resident for 4 out of the 7 tax years before you leave the UK, and your period of non-UK tax residence lasts for 5 years or less, your time overseas is a period of temporary non-residence. Temporary non-residence rules, they apply to the following. I think the big headline that they apply to is capital gains. That's the most common one we see, but also it can capture certain pension payments, lump sums. There are some tricky disguised remuneration rules, and income taxable under those specific rules can be caught by the temporary non-residence rules. Remitted foreign income for remittance basis users. I'm not going to go into the detail of that. If that's you, you know who you are. Distributions from closely controlled companies, so small companies or companies that are controlled by just a few people. Chargeable event gains, offshore income gains. There's a little bit of a list. So if you're caught by the temporary non-residence rules, the tax on these kinds of payments will then become due in the tax year that UK residence is resumed. Now, what I would say, if everything is really simple for you, if your only source of income and gains in the years whilst you're outside of the UK is going to be your overseas earnings in respect of work carried out wholly overseas, then these temporary non-residence rules are very, very unlikely to impact your UK tax position. Okay, so we've talked about getting overseas, but what are some of those key actions you need to take to prepare for your move overseas? And we'll explore these a little bit. First thing I'm going to pick up on actually is employment income. And there are a few different things to think about with employment income. I think one of the things we see really regularly as advisors is, beg your pardon, will you be asked to work back in the UK from time to time as part of your overseas role? And it's very common that you are asked to do this. Now, you are allowed to do work days in the UK and still be non-UK tax resident. A completely separate question is, will the earnings I receive for those UK work days that I'm allowed to do, will they be charged to UK tax? And that's a very, very complex question indeed. It's going to depend on the applicable double taxation agreement between the UK and the country where you're tax resident in, and whether or not there's going to be relief from UK tax because the UK work days you're doing are completely incidental to the main duties of your employment. Another consideration is whether or not you've been awarded shares, restricted stock units, or you can benefit from what we call deferred compensation from your UK employment. But perhaps those aren't going to be released to you until after you've left the UK. Now, just because you receive those payments or those shares while you're non-UK tax resident doesn't mean to say they're going to be free of UK income tax and national insurance. It's very, very likely that the value of the awards you received that accrued before you became, beg your pardon, before you became non-UK tax resident will be charged to UK income tax and UK national insurance. Another really common scenario that I see is where where someone is awarded a simple cash bonus for a performance period when they were UK tax resident. But that bonus perhaps is not paid until after they've become non-UK tax resident. Now, such a simple cash bonus is going to remain fully charged to UK income tax and national insurance, even though you do not receive that payment until after you've left the UK. You need to think about your investments. You're going to have a very different investment strategy if you're going to be working overseas for 3 years than if you're retiring overseas permanently. So work with professional advisors to understand what your personal strategy should be to attain your investment goals with as least tax taken from your investments as you can manage. And in that respect, do consider taxes and reporting requirements for your investments in the countries where you are tax resident, and indeed where your investments may be cited as well. When you move overseas in the year you leave the UK, the maximum tax relievable pension contributions will be perhaps 100% of your UK earnings, but bear in mind there is an annual allowance for that, or £3,600 if £3,600 is greater. Now, you've left the UK, and for the next 5 tax years, you can still make contributions of up to perhaps £3,600 a year and get tax relief. Now, those contributions must be to a pension scheme you were a member of before you left the UK. And there are some very specific rules around this. We mentioned having some UK work days. That's allowed and still be non-UK tax resident within some limits. But those UK work days could be charged to UK taxation. And if so, the amount that you could contribute to a UK pension scheme within those first 5 UK tax years could be the greater of those earnings which are taxable in the UK, or £3,600. And bearing in mind, there is an overriding annual allowance for tax relieved pension contributions that you can make. You also need to think about continuing to make national insurance contributions as a non-UK tax resident. It's surprisingly complicated. The bottom line is that you will be able to do this. So why would you? Well, you need 35 years of records of making national insurance contributions to receive your absolute maximum state pension, if that's important to you. So letting your property while you're away from the UK. I think one of the key considerations for couples is who should be taxed on the rental income that you're going to receive as a non-UK tax resident. Now, one spouse may have an available income tax allowance and the other spouse may not. Perhaps that other spouse has ongoing UK income, or they may not have the right passport to get that benefit of the income tax allowance. Now, from a UK tax perspective, it may be easy to change the beneficial ownership of the property for married couples or civil partners. And that also then changes whose name the property income will be taxable in. But do watch out for stamp duty, land tax charges, and any tax charges and reporting requirements for any such changes in any relevant overseas jurisdiction as well. What else do you need to think about? You need to think about things like council tax. What do you need to tell the local authority? What council tax will you pay? Your mortgage, if the property is mortgaged, does the mortgage provider actually allow you to let the property? Insurance, do you need a special landlord's insurance? I'll just pick up also on using a letting agent. So while you're based overseas, having an agent to look after the property for you is actually a great idea, but that does come at a cost with those letting agents' fees. Now, you can claim certain expenses against your rental income to reduce your tax bill. Most expenses can be claimed if they are incurred by you wholly and exclusively in earning profits from your property letting business. And they're regarded as what we call in tax terms of being of a revenue nature. So it's probably easiest to describe what isn't revenue. So what wouldn't be allowable are things that we call capital costs. So adding an extension or a conservatory, upgrading the property, building up into the loft space, putting a swimming pool in the basement if you want to do that. Now, these types of costs are generally not going to be allowable against your letting income, but they are going to be allowable when you calculate the gain arising on sale. Mortgage interest, you'll see that on there. Mortgage interest is no longer deducted as an expense against the rental income. But you do get some relief. Instead, relief for mortgage interest and actually other finance costs will be received as a credit, which reduces the income tax liability and is restricted to a maximum tax credit of 20%. Okay, really such a common question, which is, I think, one of the most common questions I get asked. No, you cannot claim the cost of your flight back to the UK to visit your buy-to-let property as a deduction against your rental income. That simply is not allowed. I'm going to mention the non-resident landlord scheme. Now, special rules apply to the UK rental income of non-UK resident landlords or landlords who live abroad, usually for more than 6 months. If you do not sign up to the non-resident landlord scheme, your tenant or your agents will be obliged to deduct 20% tax at source from all the payments they make to you, whether or not that tax is actually due. Now, signing up to the non-resident landlord scheme, it doesn't make the rental income free of tax, but it does stop an automatic 20% tax withholding at source on those payments that you receive. By signing up to the scheme, you're committing to completing tax returns, submitting them on time, and paying your tax on time as well. Another thing that's really quite common is that you move overseas and then a little bit later on you think about perhaps, well, really like it out here, we're not going to go back to the UK. Should we actually sell our property in the UK? So when you dispose of a UK property as a non-UK resident, now provided that you're non-UK tax resident for more than 5 years, bit of a tickle. Provided you're non-UK tax resident for more than 5 years, it's only the gain arising after 5th of April 2015 that is charged to UK capital gains tax. And that could be really advantageous for you if you've owned the property for quite some time. Could be a big advantage. Now, bear in mind, capital gains tax on property is charged at the higher rates of 18% and 28%. And also bear in mind your capital gains tax exemption, £12,300 last year, £6,000 this year, £3,000 next year. It's disappearing over the horizon. An important consideration here is that the disposal of UK property needs to be reported to HM Revenue within 60 days of doing it. And if there is tax to pay, that tax needs to be calculated and paid within 60 days as well. Now, if you've ever lived in the property as your main home, matters are far from straightforward. And this is very common. You move out of your property in the UK, it used to be the family home, you move overseas and you think about selling it. Now, it may not be better to sell while you're UK non-resident if that property was your main home. And that is because you can get some relief from capital gains tax for the time you've lived in the property as your main home. And if you ultimately return to that property to live in it again, you can actually maximise the tax reliefs you're going to get from UK capital gains tax on that property. It's surprisingly complex, and you do need to speak to a tax advisor to understand what the best thing to do is on that property that used to be your family home, and maybe you're gonna live in it again, perhaps after a time overseas. Four's inheritance tax, the most punitive weapon in HM Revenue's arsenal. Now, inheritance tax can be a tax charge as high as 40% on everything you leave above £325,000. And remember, this is likely to be income and gains that have already been taxed through your life. Your liability to UK inheritance tax is determined by what we call your domicile status. We mentioned this previously. It's not the same as your resident status. And just to remind you, you generally acquire a domicile status from your father when you're born, and it's very difficult to change. A UK domicile is liable to inheritance tax on their worldwide asset. You can be overseas for 40 years, remain UK domiciled, and still be within that UK inheritance tax charge. However, a non-UK domicile is only charged to UK inheritance tax on their UK assets. The overseas assets are not within that 40% charge. The big advantage for being non-UK domiciled is around that UK inheritance tax charge. And one of the considerations for becoming non-UK tax resident is whether or not that gives you the opportunity to displace your UK domicile of origin with a domicile of choice outside of the UK. And that's really compelling, because if you can do that, your 40% UK inheritance tax bill is just limited to UK assets. Your overseas assets are going to escape the charge. However, and it's a huge however, acquiring a domicile of choice overseas to displace your UK domicile of origin, it's such a high bar test to meet. It really is a tough thing to do. Not quite so tough. Last point on this slide. One of the simplest ways to reduce your UK inheritance tax bill is to make lifetime gifts to your intended beneficiaries. And if you make those gifts, excuse me, you don't retain any benefit in those gifts. Maybe you're UK domiciled, you need to wait 7 years before the value of the asset you gifted is outside of your inheritance tax bill. Why you would do this when you're overseas is that you may be able to avoid or really reduce a charge to UK capital gains tax on the value of the gift. And that might be something that you want to think about while you're actually living overseas. One of the key things you need to do when you move overseas is to actually tell HM Revenue that you've gone. And there's a form, it's called a P85. And you complete that form to tell HM Revenue that you've become a non-UK tax resident. And that form tells HM Revenue about the circumstances of your move overseas and any taxable income that you may still have. If you already submit UK self-assessment tax returns, there's simply no need to complete the P85, and your departure from the UK, your date of split year treatment, for example, that can all be declared on that annual self-assessment tax return. And you can tell them about your change of address as well if you change your correspondence address. And it's really important that HM Revenue do indeed have a correct and up-to-date correspondence address for you. If you need to complete a UK tax return, for example, for ongoing rental income or to claim split year treatment in the year of departure, I've included the filing deadlines for this tax year on this slide for you. Okay. We're going to now move on and think about some of those important considerations for the first few years of living overseas. We've seen that maintaining a non-UK tax resident status really is going to limit the amount of tax you'll pay on your income and gains. You need to understand how much time you can spend in the UK without becoming UK tax resident. This is very essential. In the first 3 years of non-UK tax residence, those limits generally start at as low as 15 midnights in the UK and a maximum of 120 midnights in the UK, depending on your own personal circumstance. Just a quick mention, if you're in qualifying full-time work overseas, then those limits for you are going to be 90 midnights with no more than 30 UK work days undertaken while you are in the UK to maintain that non-UK tax resident status. Now, once you've been non-UK tax resident for more than 3 UK tax years, the limits to maintain the non-UK tax resident status start at 45 midnights, and extraordinarily in a one-off year, you might be able to do 182 midnights in the UK and still be non-UK tax resident, but again, depending on your personal circumstances. You need to think about whether or not you need to continue to complete UK tax returns. You need to be aware of the tax payment and filing deadlines. And this may apply if you've got ongoing sources of UK income, for example, pension income or UK rental income. And finally, on this slide, you need to make sure you've understood any tax filing requirements and any tax payments that may be due in the country where you're living. I live in Singapore. I need to pay tax and I need to file a tax return in Singapore every year. So working overseas. First point in this slide, we mentioned it, consider making voluntary national insurance contributions, and that's to secure the highest rate of state pension for you. 35 years of records are needed. Also, you need to consider, can you continue to contribute to a UK pension scheme while you're working overseas? Maybe you can do that in the first 5 years, provided that the conditions are right. Also, think about your investment strategy. If you don't have sources of income in the UK apart from interest, dividends, maybe a UK state pension, you can use some really quite detailed disregarded income rules, which then limits your UK taxes to the UK tax deducted at source, which is generally 0. And if that's you, if your circumstances meet the disregarded income rules, it could be the case that there's not too much more tweaking needed to the investments that you have. However, if you do have other sources of income in the UK, for example, from a let property or maybe an occupational pension scheme, then you may not be able to benefit from the disregarded income rules. And your investment income in the UK, excuse me, could be subject to UK taxation. And you need to consider your investment strategy a little bit more carefully, and it may be more tax efficient to move your investments outside of the UK at that point. I'm thinking about retiring overseas on this slide. So first point, we've mentioned it. Will this enable you to change your UK domicile status? It's extremely hard to do, extremely hard. But if you can displace your UK domicile of origin, that could almost be like a magic silver bullet that solves inheritance tax for you. But in any event, you need to understand your possible inheritance tax bill and make a plan to reduce that. Gifting to your children, for example, or into trust is one of the simple ways to reduce your inheritance tax bill. And if you're non-UK tax resident for long enough, you may be able to escape or reduce UK capital gains tax for making those kinds of gifts. And that capital gains tax you would have faced had you remained in the UK and made these gifts. You need to know what your living costs will be overseas. and how you're going to fund those living costs from your investments, including perhaps your pensions. And that leads on to another point. You need to understand whether or not the UK will tax your UK pension income. And this is going to depend on the double taxation agreement between the UK and the country that you're actually tax resident in. Now, depending on where you retire, this could give a very favourable outcome for you. The next slide, retiring overseas. This is really, really important. What you need to understand is, will your UK state pension benefit from those triple lock annual increases, or will it be frozen because of the country you're going to be living in? Now, given inflation, this is a very significant consideration for you. I've said an awful lot. I've coughed an awful lot as well. Well done for bearing with me this far. If you're struggling, we're almost there. So my key takeaways for you today. So you need to understand the date that you're going to become non-UK tax resident. If you're going to be letting a UK property, then that non-resident landlord scheme is really important for you. You want to think about whose name should the rental income actually arise in? How is there a strategy where you can reduce the UK income tax you're going to pay? There are anti-avoidance rules if you're non-UK tax residents for 5 years or less. And don't forget your reporting obligations and tax liabilities in the country you're going to be living in. That's really important too. So we're now going to do our best to answer some of the questions you've been asking. I'm going to be joined by my colleague, Chris Davies. Now, Chris is actually a financial planner, and he's actually based in our Dubai office, and he's been outside of the UK for some time. So Chris, actually, before we get stuck into the questions that you've all been asking us, I have a question for you. So Chris, tell us, in your own experience, what are the main questions that come up when people look to move abroad from a financial planning perspective?
Well, thanks very much, Peter. So I think from my side, obviously, moving away from tax and onto the financial planning, although of course they're extremely integrated, as we all know, I think the major point that comes up when people move abroad will be around currency. I think for many, it's the first time that they've had to consider currency as part of either an investment strategy or just part of their own lifestyle. If we're talking about, obviously, many British expats moving away from Britain, perhaps for the first time, everything's always been in pounds for those types of clients. They've earned in pounds, they've sent their kids to school, so they've paid in pounds, they've bought houses in pounds, and their family situation has predominantly been based in GBP. So I think when you're sort of moving abroad, particularly for the first time, you need to kind of get a grasp on the international transfer element of how you're going to move money. Moving money between the currency that you earn and the currency that perhaps you still retain some liabilities in. You mentioned earlier about perhaps having family, UK resident family, family support payments, things like that, children in school in the UK, all obviously still paid in pounds, even though you may have left the UK and are considering sending money back for those reasons. Now, we typically, therefore, very quickly start to talk about currency exchange, start to talk about companies that will work in that space. And there are, of course, some very good businesses that work as currency exchange companies, and that we would sort of look to recommend in terms of getting a better exchange rate, because you do need to make sure that you're sort of not losing out money when you're making a transfer. I work, of course, here in the Dubai office, earning in UAE dirhams pegged to the dollar, so making exchanges between dollar and pound, and effectively you want to make sure you're getting the most bang for your buck in terms of dollars back to sterling than when you're making your payments. So certainly the first sort of major question would be around currency, and just really factoring that in as part of the overall strategy and how you're going to maximize the amount of pounds you get back for your earnings abroad. I think you touched on a second point that I would raise today in terms of UK pensions. Obviously, the sort of clients that we deal with on a regular basis have built up UK pensions throughout their working careers. And often, you know, the first question is, can I continue to hold this pension, and is it suitable? Now, of course, suitability is a bespoke thing that we need to understand client circumstances. But in general, you can continue to hold a UK pension as a non-UK resident. And you touched as well on some of the contribution rules, and I think a lot of the time individuals will miss out on that first 5-year period. So you mentioned the maximum perhaps being £3,600, and you get that by making a contribution of £2,880. And then even if you don't have any income in the UK in those first 5 tax years, you'd actually be able to receive a tax-free claim of £720 to get you your £3,600 contribution for that tax year. So obviously that's £720 of effectively free money. So, you know, don't kind of look away from that. It's absolutely worth considering as part of the overall strategy. It's not perhaps going to move the needle, but it's £720 each year nonetheless. So certainly we look obviously at client pensions and looking at how we can best consider the use of those. And then I'd say kind of finally, and more broadly, it would be around the investment strategy that people have when they move abroad. It would be around, you know, typically, can I continue to invest in the same way? Do I need to make changes? You touched on disregarded income from a tax perspective, but from an investment perspective, you know, moving abroad is a massive life change. As with any change in circumstances, we think that you should sit down and evaluate how that impacts you financially. How does that change your future goals and objectives? Are you likely to move back to the UK in the future? Are you likely to move somewhere else? All of these different answers to those questions will probably come to a different answer in terms of your own investment strategy. So that one kind of is a little bit more bespoke, but certainly considering the investment strategy and where to invest from, I would say is very important. So the 3, as I said, that come up in most client conversations when considering or having moved abroad would be making sure that the currency conversation is checked off and that you understand how you're going to make those transfers, that you can continue to hold your UK pensions and invest in UK pensions and also continue to contribute. And then also that if you need to look at changing your investment strategy, both in terms of the assets that you hold, but also in terms of the jurisdiction of where those are held.
Okay, thank you, Chris. So what we're going to do now is have a look at some of the questions that you've been asking us, and between us, Chris and myself, we'll do our very best to try and give you some answers. I think the first one might be for me, actually. I live overseas and would like to sell my UK property this year. Will I have to pay tax on the property sale? Oh, goodness me, this is such a wide open question. I'm going to give you some kind of bullet point headlines on it. So even as a non-UK tax resident, the disposal of your UK property is within the charge to UK capital gains tax. You're not going to escape a possible UK capital gains tax charge simply because you're overseas. If you're non-UK tax resident continuously for more than 5 years, then the disposal of a UK property is only the gain arising from 5th of April 2015 that is going to be charged to UK capital gains tax. A couple of different ways to actually calculate that. You can either do it on a straight line time apportionment, so maybe there's 8 years after 5th of April 2015 and maybe there's 16 years before 5th of April 2015, and if I've got the maths right, that would mean that 1/3 of the gain would be charged to UK capital gains tax. Another way to do this is to seek a valuation of the property as at 5th of April 2015 from a suitably qualified valuer and use that valuation. If the property has been your main home at some point, there's a tiny little bit of relief you get. The last 9 months of ownership benefit from a capital gains tax exemption on a time apportion basis, and we call this main residence relief. Okay, probably can't say too much more than that. Next question. So Chris, I'm going to throw this one at you. As a non-resident, can you share some thoughts on where I should invest?
Yeah, thanks, Peter. I think there's probably a couple of elements to this question. So where I should invest. So I think if we start talking about an investment strategy, and very briefly, then I know my answer to that is always in a diversified portfolio globally, because we're making sure that you sort of smooth out the different returns available from investment markets. So, if we're talking about where should I invest in terms of the asset allocation, then absolutely make sure that you have all sort of major markets included in your portfolio. That's going to smooth out your return over time. If we're taking this on the angle of in terms of where should I invest from, so in terms of the jurisdiction perhaps of where the investments are held, you mentioned, and I think I mentioned as well, disregarded income and about how you might want to move the funds outside of the UK. So the Channel Islands, the Isle of Man, Ireland, all very, very popular jurisdictions for investment products. So I think it comes down to, if we're talking about the investment strategy and the investment diversification level, if we're talking about the product level, but absolutely there can be reasons to move your funds outside of the UK, as you already mentioned, and I think that we just want to make sure that clients are in a safe sort of recognised jurisdiction to hold their investments, if that needs to be outside of the UK.
Thank you, Chris. I'm actually going to jump ahead one question here, because you mentioned disregarded income, and one of the questions we have is, I've heard the term disregarded income mentioned, or I mentioned it. Please, can you explain what it means? I'll do my best with this. It's a bit of a strange concept. But if you're non-UK tax resident, you can use this basis of UK taxation that we call disregarded income. And what disregarded income does, it takes away your entitlement to a tax-free personal allowance in the UK. And if you're non-UK tax resident, you're generally entitled to that if you're a UK person. So £12,570, that tax-free allowance, is taken away from you. But the plus side to this is that then any investment income you have, including your state pension actually, so state pension, dividend income, interest income, all arising in the UK, the tax you pay on those sources of UK income is limited to the tax deducted at source. So generally, state pension, no tax deducted at source; dividend income arising in the UK, no tax deducted at source; and generally interest income arising in the UK, no tax deducted at source. So your UK income tax liability on those sources will be zero. So it doesn't matter that you've lost your income tax personal allowance, because you don't have a UK tax liability. Now, where this doesn't work is if you have sources of income arising in the UK which are not disregarded income. So this might be income from a property or income from an occupational pension scheme. So in that case, having your tax-free personal allowance, £12,570, becomes much more important to you. And when you get into that situation, what you want to then think about is, well, actually, I'm going to pay tax on my investment income in the UK. Should I just move that outside of the UK and just lose that UK income tax liability on those sources of UK investment income? I realise there's quite a long explanation, but hopefully that does make some sense. So just skipping back up a question, the question that was asked before this one, how will I know that I have enough to retire? So Chris, I'm going to throw that one at you.
Yeah, thanks, Peter. So I think obviously in context of today's webinar, thinking about being abroad, obviously that brings with it, as you've already mentioned, a different cost of living. So of course, the first and most obvious thing to say is to look at a sort of budgeting exercise to understand exactly how much you need to retire. So in terms of looking at that number, you need to sort of calculate your ongoing expenses and what you want your lifestyle to look like. And, personally, I have clients that could get by on 20,000 and clients that need in the hundreds of thousands per annum to live comfortably for them. And you just need to obviously work out what that number looks like for you. I think kind of to help answer this question in a way, it is to understand what the numbers we look at when we have an investment portfolio, what do they actually translate to in retirement? I think that's sometimes a calculation that can be quite confusing for clients. And I think the most general way of looking at this, sort of from the academic literature, is that if you have a portfolio of investment assets, that portfolio can sustain a drawdown rate of around 4% per annum, increasing by inflation for over about a 30-year period, which we would say is a pretty standard retirement timeframe these days. So, putting that in context, if you have a pot of investments worth £1 million, for example, you're talking about a sort of £40,000 income stream increasing by inflation each year. That way, if we flip the question on its head, we can obviously then start to think, well, is that enough? Once you've done the budgeting exercise and you know what you have in a portfolio or in your investments, excluding the property that you live in typically, then you'll know whether there's a mismatch there and if there's work to be done.
Okay, thank you, Chris. I obviously need to work a lot harder over the next few years. So next question. I've been living outside of the UK for 20 years and have no intention to return to the UK. Does this mean I'm exempt from paying inheritance tax? Oh, goodness me, this is a great question. Apologies. So if you're UK domiciled of origin, it is possible to displace that UK domicile of origin with a domicile of choice overseas. It's a really tough thing to do, but it is possible. And don't take any action on the basis of my next comments. Speak to an advisor. So there are two things that you need to do to displace your UK domicile of origin. The first is you need to leave the UK completely behind you. You need to be able to demonstrate that you simply have no intention at all ever to live in the UK again, and you don't really have any affection for the UK anymore. It's how you demonstrate that intention that can be quite tough. So that's the first part that you need to do towards the UK. The second part you need to do is towards another country. You need to make it absolutely clear that you've chosen another country to be your permanent home for the rest of your life. You live there and you cannot foresee any circumstances where you would ever leave this country. And your actions and your intentions bear out that premise. So to answer the question, I've been living outside the UK for 20 years and have no intention to return to the UK. Does this mean I'm exempt from paying inheritance tax? Maybe. I think we need to talk to you, but remember that displacing that UK domicile of origin, just being outside of the UK for 20 years and having no intention to return to the UK is not enough. You need to have chosen another country to be your permanent home, and you need to be able to demonstrate the intentions both towards the UK and the country that you're living in and have chosen to be your permanent home. Okay, apologies, that's as much time as we have for the questions. If we didn't get to answer your question, I am sorry for that. So please do follow up with us afterwards. Chris, thank you so much for your input on that. It was absolutely great.
Thank you, Peter.
So what I'm going to do now is just a very brief introduction to the Fry Group. So if you look at our website, you'll see we've got some great resources there. So have a look, and there are a couple of guides around leaving the UK. Your guide to leaving the UK, an expat's guide to UK tax. Have a look at those. Now, the Fry Group was established more than 120 years ago. Since then, we've helped thousands of people around the world and across generations. Today, we have 8 offices around the world, so we can offer a global perspective. Our services cover 3 core areas of financial planning: tax, which is where I sit, estates and trusts, and investments, which is where Chris sits. Our teams work together across these 3 areas and across countries to create the right balance for each client. And our core purpose is to help people achieve financial freedom. We understand this means different things to different people. So we take time to find out what is important to you so we can structure your finances around your goals. have some contact details here. You're going to be emailed these slides, so you will actually have these contact details. Finally, a massive thank you for your participation today. Thank you for joining the webinar. You're going to be sent a feedback form. So please do complete that feedback. It's a great tool for us to understand perhaps what next topics we would like to explore with you on future webinars. So thank you so much for your time and attention today, and we look forward to seeing you on our next webinar. Thank you.